earlier this year just kept sailing away and is at new highs and surging. Yet investors suddenly, Michael Burr, who called the 2007 to 2008 housing crisis correctly, is betting 80% of his multi-billion-dollar portfolio against some of the biggest names in AI and tech. Market crash and recession 2025 are spiking. Volatility is creeping up, and even big-name funds are and all the hype going on there. I actually do real research. The American Association of Individual Investors conducts a weekly survey on investors' view on the financial market for the next 6 months. The S&P 500 and NASDAQ have stalled after a massive run. The VIX, Wall Street's fear gauge, is quietly trending higher. Bond yields remain stubbornly high. That's Wall Street saying, we're not convinced inflation is dead. And online sentiment. Google searches for stock market crash jumped nearly 40% in the last month. Reason number one that we're seeing this is valuations. Even after earnings season, forward Ps for large cap growth stocks are sitting way above their 5-year averages, like Meta's 20% post-earnings drop. And even Palantir had a huge earnings report, but after that, they dropped off big. Reason number two we're seeing this negative sentiment is interest rate fatigue. The Fed might be done hiking those rates, but they're definitely not cutting super aggressively. Rates are higher for longer, and that weighs on valuations, borrowing, and consumer credit. Think about it. A business refinancing their debt at 6% instead of at 3% means slower profit and slower growth. Reason number three right now is fiscal and geopolitical noise. We've got the UK talking about broad tax hikes. As I take my decisions on both tax and spend, I will do what is necessary. US budget debates heating up. The United States has not only become more active on the diplomatic front, they are actively pressuring their main trading partners with tariffs, trying to reduce their trade deficit in this way, while simultaneously seeking to improve the budget deficit situation and a global election cycle ahead. There's also always something going on with the US and China and the whole tariff situation. And currently, our government is shut down. When governments tighten belt, liquidity drains from the system and markets feel it. The biggest measure of nervousness quietly becoming bigger and bigger. So let me show you that and give you 4 easy quick steps that I'm taking in my portfolio. CNN's Fear and Greed Index recently slid from 75, which is greed, to 23. Extreme fear. That's cooling momentum and going the opposite way. People are freaked out. Like I talked about at the beginning of this video, AI investor sentiment recently has had bullish responses, dropped from 48% to 35% in just 2 weeks. People are flipping like crazy. Third, you have put-to-call ratios. More investors are buying protection, signaling quiet hedging. Michael Burr, who bet on a U.S. housing market crash in the run-up to the 2007 crisis, has wagered $1.1 billion on falls in shares of chipmaker NVIDIA and software company Palantir. Moves will intensify concerns about a possible bubble in AI stock following a surge in values driven by hopes of huge future earnings in the sector. 4 steps to pull your portfolio out of harm's way. Step number 1, you're going to want to trim Matt Fraud. If your portfolio's 40, 50, 60% mega cap tech, consider rebalancing. Lock in some profits. Step number 2, which is something you're going to want to add quality and dividend. ETFs like SCHD or VTV focus on companies with stable cash, slow and solid balance sheets, the kind that weather slowdowns. Step number 3, short-term treasuries and money market funds are paying 4 to 5%. There's no shame in parking cash and waiting for better entry point. SGOV is one of my favorite short-term treasuries ETFs. Or you could just be holding that in your brokerage account's money market or even a high-yield savings account. Mix with 60 in core equities like the total U.S. stock market or the S&P 500. 30 in defensive or dividend plays like SCHD or VTV or VYM. And then maybe 10% in cash that keeps you participating while staying protected. For those of you that are a little bit younger and can handle this volatility, you could have a little bit more in the growth ETFs as well. So you can do the 3-fund portfolio. Just make sure that you're balanced. I just want to make sure everybody's not fully in growth or tech at this point, because here's the bottom line. Markets rarely crash when everybody's ready for it. They do definitely punish complacency. So if you're thinking, well, I'll move eventually, like once it starts to drop, it could drop very quickly at the drop of a hat. You'll be left there holding the bag. Use this period of nervousness to strengthen your portfolio, not to fear it. Watch this video on the newest value ETF that I'm adding.